Right. Hi everyone. Today I'm back to the office. It's about 11:30. I'm going to do this recording. A bit hungry, so I'll going to have my lunch after this video recording. So anyway, good to have everyone back. I hope you have a good time at home. Right. Right. Today I'm going to talk about options, right? Chapter 11, Part 1. Okay, let me just do something. What am I supposed to do? Oh, yeah, sorry. Right, so here we have Chapter 11, the last derivative on options. So, what is options? Okay, so the name itself kind of tell you what exactly is option. Uh, Nowadays, many investors' portfolios will include what we have mentioned before, the mutual funds, stocks, and bond. But a varieties of securities you have at your disposable does not end here, right? So another type of security is now what we're going to look at is actually the options, right? Basically, it presents the world another opportunity to sophisticated investors, sorry, on how to basically reduce. Right. Again, we always talk about reducing the risk. So the power of options lies in the usefulness, right? Flexibility, where it actually allows you to have the options or for you to adjust your position according to any situation that might arise, right? So the option can be speculative or it can be as conservative as you want. So you can basically come up with your own options. Um, Right. So incidentally, you can see that the option is actually a contract that gives the buyer the rights. Okay. So options is like giving you options, right? That you can decide whether you want to exercise, but you have and not the obligations, right? So you have the option to say no or cancel it, right? So options has basically two allowed you to buy or sell something at a price. So it's also like stock and bond as a security. So options, just take note, there's a call options or a put options. Two options that you need to be aware, to be clear, right? So one is basically to buy, the other one is basically to state the selling price. So take note of the differences, very important. And on the option contract, there's also the underlying assets. Okay, so there's also the expiry, uh, when the option will expire, so will cease to exist. Then there's also the strike price, okay, which is the price stated on the option. What is the price that they have to exercise? Okay, and options, since there's actually a deposit, or sometimes we call this the premium that you need to pay, right? So it's something that you need to pay upfront. So there's a upfront fees. So unlike future contract, there's no upfront fee. But here in the option contract, there's actually a option price that you need to pay a option premium. So uh, So there's also some differences in options, basically in the two area, whether you are trading the options in Europe or in America, right? So in Europe, their options is slightly different. You can only exercise the option at the expiry date, right? Only at that date that you can exercise. Whereas an American option is more flexible, right? It can be exercised anytime before the expiry date. Okay, so it has a even greater flexibility in terms of in the US options. So, but in any case, if you have any options contract, do read the clause carefully. Do read the whatever information that's given on the contract, especially those fine print. Right. So here we take a look at these options. right? So options, there's well, we start out with doing this call options, right? So call options is basically stating the rights and but not the obligation to buy something. Right? Take note, the keyword is actually buy. So call associate to buying price. Right? So you state the buying price. So options basically there's two lah. Right? You can state the buying price, or you can say I want the option to sell at certain price. So here we are looking at call options, right? And buyer means the holder. Later on we'll talk about this holder. So there's a strike price. So what price you want to state, want to be agreed of, right? And at a future time, the expiry time that you want to agree, right? So since holder, okay, the holder has the rights, so they have to pay the premium to the writer, right? So the writer, basically they are the person who sell the options. So you have to give them an incentive because they are obliged by whatever rights that you're going to exercise, right? So here we have a diagram to basically show the two different person, right? So in the options, typically there's two parties again, right? One is a buyer, right? Obviously, and the other one is the seller. Sometimes we call this the option writer. So it's like you can take it as the seller is selling the options, the documents, right? So the seller will basically write the options, okay, and then the buyer will basically purchase the option contract, right? So since I'm buying the contract, I have to make a payment, right? Right? So I want to own the rights to say something about this agreement, to exercise or not to exercise. So I need to pay a premium, right? Because in this case, the seller or the writer, they are at the mercy of the buyer, right? So the buyer can exercise the option, or if the options doesn't favor them, then they can walk away. They don't want. I say they don't want. So in the events that the options is not being exercised, the writer or the seller in this case will get to keep the premium, keep the payment. This will keep the payment. So whatever payment premium you pay, right? You will be, if you never exercise, the option rider will basically can get the premium, right? Can get the deposit in a way, right? So these are governed by the option clearing corporations, right? So that it's like a middleman to ensure that such payments is carried out, right? So just now we saw the holder, right? So which is the buyer, right? Because they hold in a way they hold the options. They sell the options and then they hold the options. So they are the holder or the buyer. Right. On the other hand, there's the other party, which is actually the one who write the options or sell the options. So since they sell the options, they don't have the rights. They have the obligations, right? They have the obligation to do whatever the holder want. Okay, whether to buy at the specific price or walk away, right? So the holder has got the right to exercise his right, and when the holder exercise the right, the seller will oblige to sell at the price, right? So in return for this obligation, that's the reason why the writer can receive the premium paid by the holder first, right? They can hold on to the premium first. So so what we have seen is we have seen the two types of options, right? The two types of option. One is the call, which is the right to buy something at certain buying price, written buying price, right? So they specify the buying price. Put, on the other hand, is the right, okay, to set the selling price, right? I want to set the selling price. So you can write an option, I want to buy the pen at what price, $3, or you can set, as a seller, I can set I want to sell the pen at $3 also, right? So it's up to you. So you can either be one of them. So this is the right to buy and the right to sell for the put options. So in other way, call is like a long position. Remember, the long is like buy, right? The put is like short. So the same concept can be applied, right? When you want to buy something, you always think that the market is bullish, right? So usually investor will go into a call options when the market is going up bullish. But if you want to sell the call options, you are usually think that the market or the economy is going down bearish, right? Just like a bear, very sloppy, very lazy, right? So here again, a quick rundown on the participants. So in any case, it can either be if you set a call options, then you have a buyer for the call and a seller for the call, right? So these two exist together as a pair, right? So since the buyer of the call means they have the rights to buy, okay, buy whatever option price that's given, right? On the other hand, this is another pair, right? Another pair. So you have a buyer for the put and the seller for the put. So they exist as a pair. So, but in a put, options means the right to sell at certain price. Okay, and again, this buy means the holder, the sell means the writer, right? So this we talk about this, right? So here we basically just telling you the distinction between the buyer and the seller. So holder, the buyer, they have the right but not the obligations, right? They have a choice. Okay, oblige means they can have a choice, right, to exercise or not to exercise, right? And writer, when you are a writer, when you are a seller, when you are a writer or a seller, then you are at the mercy, right? You are obliged to buy or sell depending on what the holder, whether they want to exercise or not. So basically, the whole thing is summarized on this table. I think it's good and important to take note of this table. This kind of summarize what we have gone through. If you are still confused, right, then you better jolly well remember this table, right? So here we have a call, means buy, right? The right to buy, the right to buy. Put means the right to sell. So when it comes to right means no obligation, no obligation. And you have a holder, the buyer, but the holder will pay a premium, right? Since I have the rights. So when you want rights, then you have to pay a visa, right? If you no right, like this one no right means they are obliged. Okay, they are obliged to do. So when you have a call buyer to buy something, then you have a call seller to sell something, or a call writer to sell the something. Since I'm the mercy, I get to receive whatever deposit that is or hold the deposit of the buyer, right? So this is the when so this is just the reverse, right? When you have somebody's right to sell, then you need to have another person to buy, right? So I have the right to sell you, and then you have to buy at that price, right? So these tables is important for you to get a view, right? So please spend some time, look at this, and hopefully try to remember, right? So these are the very important concepts that you should take note. So here, same thing, basically just repeat what we are saying. The holder, right, exercise the right to buy. And so if the holder of the options, okay, what happens if they hold the thing, then on expiry, okay, never exercise, never use it, then the option will become worthless. In fact, it will make a loss, right? Because it will lose. If you never exercise the options for the holder, they will lose the premium. On the other hand, right, the seller of the options, if the option get expired, okay, basically they gain something, right? The option is become useless in a way, you cannot exercise anymore because expiry area, right? The options is expired. You fail to exercise. But then what the seller have is it has a gain, right? It gains to receive the or even keep the premium, right? Since you never exercise, so I keep the premium, lor, right? I keep the premium that is paid by the holder. So that's what it means. So it's just to tell you that if you never exercise the options, right, the option itself upon expiry, it become meaningless, right? The contract cannot be fulfilled. You never exercise it over, right? So it's no longer usefulness. But on the other hand, right, the holder will stand to lose their premium, and the seller will stand to gain the premium payment. So here are a bit more on the strike price, the terminologies of the options. Strike price means the price that they can exercise on the options, right? So then there's also the stop price, which is the fluctuating price. So strike price is the price that they can exercise on expiry. So if the options is in the money, simply means in the money means make money, is worth, it's worth. So usually it pegged to the whatever underlying price, right? So if the underlying price is going up, right, so likely your options is more valuable, right? And the options is basically in the money. It's like oh, money goes inside your pocket. So you're basically making money, right? If it's out of the money means money taken out, so it's losing money. So let's take a look at this example on buying house, right? So next time when you buy a house, you will also have this option to purchase, right? So there's a period of 1 week or two where you can think about it, right, before you pay the full payment, right, or commit into buying. So buying house is actually a big item. It costs a lot of money. So sometimes you need to take time to think about it, right, or research more or negotiate, but you just want to fix the price first, right, of the price that you the housing price that you're interested. Sometimes you also need to check with your banks, okay, whether the banks is able to give you the housing loan, right? So what happen if you didn't get the housing loan, right? The bank doesn't want to lend you. Maybe you have bad debt, you're bankrupt, or you don't have the means to pay back the loan, right? So the banks will have to evaluate whether you want to take loan from the bank. The bank will have the rights to basically evaluate whether you are capable of doing the payment. So they either ask you for income statements, for collateral that you need to pledge, right? If you're rich, right? So they will have to they will ask some of these things. Either they will have to look at your saving also. You can also show them, well, you've got 1-2 million in your saving account. You show them, then they can see, oh, there's money there. So you can also use that to pledge, right, for the loan, right? So let's say you're not earning anything, but at least you got saving, and you show them that you are capable of paying some of this installment, right? So this has to be done during in the process of buying a house, right? So I also mentioned buying house take some time to process the whole transactions, right? So here we have the case, right? Case studies that talk about you found a house and you want to have the option to buy the house in 3 months time, okay, at a what, at a agreeable strike price, let's say 200,000. You see, what, you like this house, you want to buy the house in 3 months time, right, at 200,000, right? So you ask the owner to help you hold the house, keep the house for 3 months. At the meantime, you got to pay the owner, right, a deposit, right, something, a premium, right? So let's say $3,000 for him to hold the house for you, and not to sell, agree not to sell to any other potential seller, buyer later on, right? So you got to pay them the 3,000, right? So that's the option to purchase, right, and give your premium 3,000, right? So in the event if you don't want, right, you can walk away, but then the owner will keep your $3,000, right, your deposit. So let's say 3 months later, then it was discovered that the house was actually the true birthplace of some famous guy, so Elvis, right? So the market value of the house rocket high, skyrocket high to $1 million, right? So initially the house only worth 200,000, now become $1 million. That's a lot, right? So if you have got the options, then the seller, the owner of the house, has no choice but to sell the house at 200,000, right? Which is the strike price, the option price that you have agreed, right? So in the end, is what you can get to buy the house cheaply at 200,000. And what you can do is you might want to quickly sell it on the market, because since the market price is now 1 million, and that's where you can immediately profit. Okay, profit about almost 800k, 800,000, right? So if you want to minus off the deposit that you pay, these are just some calculations, so it's about 800k. So that's a good profit over there, and what about if it went the other way, right? The house, instead of is a true birthplace of some famous guy, and you decide is the house is actually haunted. Okay, so now the house become haunted. So what happened? The house price will drop, right? The housing price. So initially it's worth 200,000, now become maybe worth less than that. Haunted. Nobody want to buy, right? So it might drop to $100,000, right? So now, but you have got the options, right? You just purchase the option to, right, purchase. So you have you have no obligation to buy the house, right? You can walk away. You say, the house not worth that much already. I don't want it, right? It's haunted. I don't want to stay there anymore. So you can walk away, okay, from the agreement. No penalty. The only penalty, of course, is $3,000, right? So you rather lost 3,000 than to lose more than 50% of the housing value, right? Or get to stay in the haunted house, right? So you choose. So in this situation, you find that having these obligations, or at least helps you a bit, right? So if you are undecisive, or you're not sure the market price could go down, right? So you can go into this option to purchase. So why use options? Again, the two main reasons we have been talking about this derivative, right? So is to speculate, or even to fix, to mitigate the risk, right? So speculation is the territory in which big money sometimes can be made, or sometimes can be lost. This is a gamble, right? So the use of options in this manner, sometimes it has a reputation of being risky, right? But this is something that you have to determine whether it's safe or not safe. So you have to look at the direction of the stock price, the economic, which movement is it trending up, or is it trending down, right? So sometimes you have to do your own data analytic predictions, etc., and you have to weigh the options, whether to take the options or not to take the options. So hedging is similar, right? So it's also a way for you to hedge something at a price that you are comfortable, right? So by using the option, you're able to restrict that how much loss you can make, okay, or you will suffer by simply opt out, right? So, and at the same time, you get to enjoy if the markets tend to go on the upsides, right? So it's actually cost effective, because you just have to pay a little bit of premium, okay, and buy yourself some insurance where you can walk away if the market is no good, right? The price is no good, but you also get the options to the rights to enjoy, right? If the market become favorable. So it's like hedging. So here we talk about stock options, right? Stock options mean giving employees some options, right? So you have heard some companies, right? They give stock options to employees, such as Google, right? If you work in Google, you work in Microsoft or IBM, sometimes instead of paying good salary, right? Other than paying a good salary to their employee, another way to hold their employee is by giving employee some stock, okay, options, right? They give the employee an options to own a portion of the company shares or company stocks, right? So if you believe you're an employee, if you believe the company is going to do well and continue to stock price will go up, right? Then you can hold on some of this cheap uh, stock price that the company will give you, right? So in times where the stock option goes up, you can actually encash it, right, for your benefit. So it's a win-win situation, right? So employees, if they really uh, for the company and believe in the company and they will basically take on some of this stock option, and so usually some of these stock options is quite cheap, right? The company will basically sell you at a very relatively cheaper than market value. Okay, so it's usually quite worthwhile to take on. But of course, this is a stock option, which means that they give the employee the options to buy to pay for the cheaper options, right? Or if you think that you need more disposable income, then you don't take up the stock options, right? You don't take up the options to purchase. So here give you another some examples, right, on the stocks. Okay, so we have one stocks called the ABC stocks. Price at market price is $67, for example. Then you have this call options. Okay, so this call options for this stock is actually valued at $70, right? So the premium that you need to pay, or the stock price, stock option price that you need to pay is like $3.15, right? So since you are talking about 100, okay, 100 shares, so you times 100, right? So we just assume it's 100 share. So the whole the total price for the option contract is actually $3.15 per share times 100. So it become this is the premium, right? The stock premium price for 100 shares for this stock options, right? So you got to pay this amount, right? So and that is the strike price given at $70, right? So um, there's this stock options clearing house and brokers, so you might need to take into consideration some of these commissions, right? So commissions are paid for every transactions, whether you buy or sell, you have to pay the commissions, sales commissions, right, or brokerage commissions or brokerage fees. So you have to consider. But in our case studies, we just ignore this for simple calculations. So now we have this scenario where the stock price is 67, the market price, right, becomes 67. So the question is the option still good or worthless, right? So so you look at this, the call options is $70, right? Versus market price, current market price 67. So isn't it lower than your call option to buy at 70, where now the market is selling at 67, which is cheaper? Obviously, the market price, current price is 67 is cheaper. So which means that the call option to buy at $70 is not worthwhile, right? It become worthless, right? It become worthless. So the call options, whoever hold these call options July 70 and when you supposed to exercise in July, right? July at $70, where now it's 67, you wouldn't want to exercise, right? So you will let the option expire. Okay, you will let the option expire. So what's your loss? Your loss will be this, right? This is your premium, right? So if you are the holder, you have already paid for this premium $315. You will lose this $300, right? $315 for the options. Whoever the writer will basically get to keep since you're not accepting it. So you will lose these options. So you're down with that amount. So on the other hand, there's this 3 weeks. After the 3 weeks, the stock price is 78, right? The options is 78, right? So what happens if now the stock price is 78? The options increase from the stock price. So now so the stock price, instead of the 70, now stock price goes up to 78, right? So when the stock price goes up, naturally the stock options also goes up, right? So from $3.15 it went up to $8.25, right? So it worth the stock option price will worth 800 plus. So you subtract that to the contract. Basically, if you just by trading the stock, right? Trading the stock. Just now the stock options price is $3.15, and then it went up to $8.25. So you basically, if you trade the stock options, okay, stock option by selling off your call options because that's some value, you can basically take profits of 510, right? So that almost double, right? From 300 become almost double is 600. It's more than double of your value, right? In this, so basically you are basically closing your position by selling off your stock options, right? So that's one scenario where you can actually profit by selling off your stock options, right? So but what happens if it's dropped? Okay, instead of going up to 78, right? Right, you have suppose your stock option is 70, now it went down to 62, which is worse, so less than yours this. So what you have is you basically can just don't exercise the options or wait until the stock option expire and become worthless, right? So what you have is you only stand to lose your original premium 300 plus, so you only stand to lose your previous. So here is just a recap on what happened to the stock option investment, right? So just giving you that the July is 70. So the stock options, if it goes down, right? So the contract value is this amount, 100 shares. So on expiry, if it's go down to 62, right, it's less than this, so you can walk away. So what you do is you only lose the contract value, okay, the premium. But if it goes up, just now what we mentioned, instead of 70 it goes up to 678, right? So there is some profit, so your stock option price also goes up. Since the stock price goes up, right, your option price also become valuable, right? So this goes up, right? 78 is still above the 70. So the stock option itself, you can actually sell your stock options, right? If you sell your stock options, basically you profit from this 510, right? So how do you get this? Is basically this minus this amount, right? That's how you get your gain, your paper gain, right? But if you exercise, you trade the stock options, right? Stock option, we are talking about stock options, right? So but of course you can trade out your stock options, okay, or you can exercise the stock options. You can exercise the stock option. So you can exercise the stock option by uh, selling, by exercising the stocks, which means that now you can actually buy at buy at 70, right? You can buy at 70 and you can sell at 78, right? You can sell at 78. So you take a profit of $8 per share. So if you have 100 share, which means what? You profit 100 times $8 is $100, right? So you can weigh out, is $100 profits better, which means you exercise the stock options and go and buy the actual share. We're talking about buying the actual share versus this, right? So this is just trading the stock options paper, selling your call options. So you profit $500. Okay, so in this case, you can actually have two options. Either you sell your paper to someone else, okay, at 500 and earn this 510, right, on the May before the July expire, or you can exercise it on the expiry, and you can basically gain, okay, profit from the $800 shares, okay, by trading the shares. So the options basically give the holders the rights to do something. Okay, it gives you the options. The forward or future, on the other hand, there's no options. The two parties are committed to the action. They're committed. They are binded by the agreement, by the contract. They have to fulfill. They have to fulfill commitment, right? On the other hand, the holder options, you have got the rights. Okay, so just take note of the differences, right? When you do the purchase of the options. So because of these rights, the options will require a upfront fees. Okay, upfront payment. Right. So yes. So with that, thank you again for your attention. That's kind of wrap up on the option part one. We will come back to the options again, revisit on these options in the second part. Right. So do stay tuned for the next part of the lecture recording. So again, signing out from my little office. Thank you.